Listen to me closely. If you are trading every single fair value gap you see on a chart, you are not trading. You are gambling. You are feeding the liquidity pool for the very algorithm you are trying to understand. The market does not care about your rectangle. It does not care that you marked 3 down candles and drew a box. What the market cares about is narrative. It cares about efficiency. And today, we are going to fix the single biggest leak in your trading process: selection. We're going to talk about the algorithm's signature, how to distinguish a trap from a trade. Welcome back to the podcast. If you are new here, we focus on 2 things: professional mindset and precision execution using smart money concepts. We don't do hype. We don't promise Lamborghinis. We build discipline. Today is about quality over quantity. Let me take you back to a place you might recognize. It's the gap hunter phase. I remember looking at a 5-minute chart of the NASDAQ. It was a chopped-up range, just bouncing back and forth. But in my mind, I saw opportunity everywhere. There's a bullish FVG, I'd say. I'd buy it. The candle would wick through, stop me out, and then close back inside. Okay, now there's a bearish FVG, I'd say. I'd sell. Price would rip through it immediately. 2 hours later, I was down 3% on my account, exhausted, staring at a chart that looked like a crime scene of colored boxes. I was trading the pattern, but I was ignoring the logic. I was trying to catch a ride on a train that hadn't even started its engine. I thought every gap was an invitation. I didn't realize that most gaps are simply targets. This is the pain of the novice smart money trader. You have the tools, but you lack the context. You are a carpenter trying to build a house in the middle of a swamp. Here's the truth. The algorithm leaves a signature. A high probability setup doesn't just appear. It is engineered. It is the result of a specific sequence of events. If you can learn to wait for this signature, you stop being the liquidity and you start trading with the house. Lesson 1. The fuel before the fire. A high probability fair value gap must be preceded by a liquidity event. Think about it. Why would price reverse and move aggressively? Because it has collected enough orders to do so. If you see a gap form in the middle of nowhere with no liquidity sweep, be suspicious. We want to see a stop hunt or a turtle soup first. Did price just take out an old high or a swing low? Did it tap into a higher time frame order block? If the answer is no, then that gap you are looking at is likely not an entry. It is a speed bump. Think of liquidity as fuel. The market car cannot drive to the next destination without filling up the tank. When you see a sweep of a previous low followed by a reaction, that is the tank filling up. That is the first part of the signature. Stop chasing moves that haven't fueled up. Lesson 2. Violence and displacement. This is the non-negotiable. When we talk about displacement in ICT-style trading, we are not talking about a slow, lazy drift in price. We are talking about violence. We want to see energetic movement, large bodies, very small wicks. This indicates that the smart money is entering the market with intent to reprice. When you are looking for your market structure shift SS, ask yourself, did the candle break the structure with confidence? Did it smash through the level? Or did it just peak above and close weakly? A high probability FVG is created by displacement. It is the footprint of a heavy institution stepping into the market. If you have to squint to see the gap, it's not there. If you have to ask, is this displacement? The answer is usually no. Real displacement is obvious. It jumps off the screen. It screams urgency. Lesson 3. The narrative and the draw on liquidity. A gap is useless without a target. Before you ever place a limit order at a fair value gap, you must answer one question. Where is price trying to go? Is there a clean pile of equal highs above? Is there a daily volume imbalance below? The FVG is just the entry mechanism. The draw on liquidity is the reason for the trade. If you are buying a gap, but the higher time frame narrative is bearish and the draw on liquidity is below you, you are standing in front of a freight train. You are trying to catch a retracement in a trending market without realizing it. You must align your entry with the destination. The algorithm seeks 2 things: liquidity and imbalance. If you enter a trade, make sure you know exactly which liquidity pool the algorithm is reaching for next. Let's put this into a practical framework. We call it the reset protocol for your charts. I want you to visualize this. Close your eyes for a second if you are not driving. Imagine the market is a chaotic storm. Most traders are running around in the rain, getting wet, slipping in the mud. You are inside a fortress. You are watching through a window. You are safe. You see price drop. It takes out a low, panic. Retail traders are selling the breakdown. You do nothing. You watch. Suddenly, a massive green candle erupts, engulfing the last 3 candles. It leaves a clear, crisp gap in its wake. This is the signature. The storm has shifted. Now and only now do you unlock the door. You place your order at the gap. You place your stop below the swing. You set your target at the opposing high. You are not guessing. You are executing a business plan. Open your eyes at that feeling of control that comes from waiting for the signature. It comes from knowing what you are looking for. So, here is your reset protocol for tomorrow morning. Before you open your execution platform, do this. First, identify the higher time frame draw on liquidity. Where is the daily or 4-hour chart going? Second, wait for the kill zone, the specific time of day where volume injects into the market. Third, do not touch your mouse until you see a liquidity sweep, followed by violent displacement. If you don't see it, you don't trade. Period. Protecting your capital is more important than catching a move. Your challenge for the next 24 hours is simple. I want you to open your charts and find 3 examples of fake FVGs, gaps that formed without a liquidity sweep and failed immediately. Then find 1 example of a real FVG, sweep, displacement, respect, expansion. Screenshot them, put them in your journal. Train your reticular activating system to see the difference. Trading is not about being the smartest person in the room. It is about being the most disciplined. It is about waiting for the market to show its hand before you bet yours. The algorithm has a signature. Learn to read it, and you change the game. Stay patient, stay focused, trust the process, not the noise. I'll see you in the next session.